Welcome to Nasdaq TradeTalks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. We're coming to you live from Mainnet 2023 in New York City, and joining us for this segment we have Christopher Jensen, Director of Digital Asset Research at Franklin Templeton, to discuss the evolving art and science of token economics and fundamentals. Christopher, it's great to have you with us. Welcome to TradeTalks.
It's a pleasure to be here, Jill. Thank you.
You got it. And there's a belief out there that tokens don't hold any intrinsic value and that it's more for speculative reasons. How would you respond to this?
Sure, so we very much believe in, and we've set up our research process, our research team with an emphasis on fundamentals. So, momentum definitely matters. We do factor-based investing and we look at kind of machine learning factors on the momentum side, and that certainly matters. But we think fundamentals really matter as well. And what we look for there is a protocol to generate value. And then the key piece is for there to be something in the tokenomic design that allows that value to come back to and accrue into the token. Nowadays, anything can be tokenized, but that doesn't mean it makes a good investment that should go into a portfolio. So we really try to kind of do the hard work to separate out, which tokens are just spending tokens or which ones don't really have any value, and which ones are actually designed to capture the value that the protocol is creating. And that's what we look and to kind of think of as an investing token and something worthwhile digging into, and if it kind of passes our test, potentially going into a portfolio.
So it almost sounds like fundamental analysis that you would use in the equity space, right?
Sure.
So give us an example of what you and other asset managers are looking for. Like, what would be an example of a prime token that would make sense for your strategy?
Yeah, absolutely. So, so my background, right, is 100% on the buy side, principal investing in alternatives. And so, with a strong emphasis on private credit. And so, with that private credit bias, I'm worried about the downside, and I'm looking for protocols as businesses that can develop some kind of defensible reason to exist, some kind of moat, which is very hard in Web3 and crypto, right? Because open source code, it can be forked. So how can a business develop some network effects that can be sustainable and demonstrate real value creation? And then the tools that are borrowed from equity, like you mentioned, or from credit, or best practices on the venture side. We look at the size of the market opportunity, what a potential protocol could capture in terms of that opportunity. And then it really is this kind of new area of work, tokenomics, which you don't find in equity land, right, or in credit. But that's where the nitty gritty happens, because without a way for that token to capture the value, then it's not going to really have any value, and it's not going to belong in a portfolio. So if there is that element in the design, then we can use things like DCF from equity land, or relative value analysis, or some of the parts. And we'll be the first to say, right, as you mentioned in kind of your prelude, it's as much art as there is science. We don't always force a price target, but if we can, we'll come up with one, and we'll come up with a conviction level, or maybe it'll just be a relative value view. And then we've designed our process, like our portfolio construction process, to take in all these different analyst views, combine that with all the data, the price data, the volatility, covariance, and all that stuff, in addition to portfolio constraints, and that's how we ultimately come up with an overweight or an underweight for these token portfolios.
So where and how do you get the information needed to perform the analysis? I mean, is this available on FactSet, or where do you get it from?
Capital IQ, or Bloomberg, right? Sure. So, Franklin Templeton from the get-go has thought it's important to both be builders in the space and investors. So in addition to our investing lines of business, we have the Benji product where we tokenize real world assets. We also run nodes. And so the original idea there was, hey, let's actually participate in consensus and run nodes on like 10 different blockchains so that we have a copy and a primary source of data, which we can use to inform our investment process. As the industry has evolved, the vendors that are specifically focused on the data side have gotten quite good, and because it's messy. All the data's there, but it's not clean, it's not readily available. And so, folks like the TIE or Artemis or Masari here, with the conference, Token Terminal, a lot of really good vendors in this space have done a lot of the hard work of cleaning the data, properly tagging it, and then they're really working with the analyst community to think about what does that number mean? Is that a revenue line item, or is it a cost line item? Should we think of that as cost of goods sold, or really SG&A? But there are analogies that we can use here. So where do we get the data? We now rely on our primary source of data coming off the blockchain and really supplement that with what's coming from the vendors. And we can actually feed these into our models. And one of the great things about crypto, as they say, right, is you don't have to wait for 45 days after quarter end to update the financials, right? Or on the private credit, we would get monthly financials. But here in crypto, we can run daily real-time financials. Yeah. And that's really powerful.
Which is so interesting, because when you think about it from the traditional sell-side analyst point of view, and when you kind of grow up in the business, and it seems as if you almost have to be more of a data, technological background to be a research analyst within your space. But I want to ask you about a relatively new concept, years to profitability.
Yeah.
Right? Why is it a helpful metric when you're assessing token fundamentals?
Yeah, it's a great question, and because a lot of times people will, even in valuation land, from the analyst community, they'll think about price to sales or price to earnings, when looking at token kind of fundamentals, right? And those are, price to sales is a metric for maybe, is the protocol generating value? And if they are, someone would be willing to pay for a product or service. So that's totally valid, right? But the cost side of the equation is what we think sometimes gets overlooked. And when you think about these protocols, especially layer one blockchains, what do they do? A layer one blockchain is essentially a business that is selling secured block space and whose cost is the security, what it takes to secure the network. And so Ethereum or Solana, any of these layer one blockchains, they generate fees, and then with that money, they pay the people who are providing security to the network. Now, these are proof of stake blockchains, so you're paying the validators, right, for consensus. And what's left over, then a question becomes, that's almost like gross profit. So what are they doing with that, right? And a lot of them are using that money to burn tokens. So that's really interesting, because the circulating supply would go down with those tokens being burned, right? But then there's always a token emission schedule that is increasing the circulating supply. And this is a really kind of powerful concept that sometimes gets overlooked, because some of these protocols will have really high inflation schedules, and some are more modest, and some don't burn tokens. But ultimately what we care about is that net kind of token supply. Is it going up? Is it going down? But this is all programmatic, right? It's built into the tokenomic design of the protocol, so we know it, right? And so what we can do is borrow a concept from TradFi of, hey, what's the payback period, right? What's the profitability analysis? And what happens is when you apply that framework across protocols, you come up with a way to do relative value analysis. And again, it's by looking at the cost side. What are they paying for growth in users on the network?
Right, and of course, really supply and demand is going to impact it as well, just like it would with any TradFi asset.
Yeah, absolutely, and because a lot of times you'll see growth, right, and you'll think it's a good thing, but if it's all paid growth, it's really, what's the return on capital from that spend?
Now, are there products available, institutional products or retail products that takes this analysis and you package it into something like an ETF, or there's some sort of alternative asset that this is all packaged into?
Yeah, so as I mentioned, so at Franklin Templeton, we have kind of the building side of the house and the investing side of the house. So on the investing side of the house, we kind of have two products or avenues for a client to get digital asset exposure. So we have a venture arm focused on kind of early stage VC. And then where I sit is really on the token team and thinking about the research and fundamentals of how you evaluate tokens. So we take all these frameworks and we use that to think about and do the hard work on these individual tokens to construct token portfolios that would then go to clients. And we can distribute that through the RIA channel or do separately managed accounts, that sort of thing. And which is really cool to give a client exposure purely on the token side by using some of these new frameworks.
All right, Christopher, we appreciate the insight. Thanks for joining us on Trade Talks.
Thank you.
And thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.